There were nearly 4 decades between the crash of 1929 and the bear market of 1968. Fast forward to the 21st century, only 20 years passed between 3 financial crises: the 2001 dot-com crash, the 2008 global financial crisis, and in 2020, the COVID-19 pandemic economic recession. What used to be rare, isolated events are increasingly becoming more frequent. In fact, 68% of investors with investable assets of $100,000 or more expect to live through more financial crises in their lifetime, according to Nationwide's Advisor Authority study. What's more, 35% of investors surveyed expect to live through 3 or more additional crises. One of the best ways an investor can prepare for future financial crisis is to look back at previous events. While economic recession of COVID-19 pandemic is certainly on top of our minds, the 2008 financial crisis still weighs heavily on investors' financial decision-making today. Dr. Marco Metzler from DMSA claimed the collapse of Evergrande is the first domino of the eventual destruction of the world's financial system. Due to the size of the property market, estimated at $55 trillion, he claimed the collapse of China's property market will create a worse financial meltdown than what was seen in 2008. In this video, we are going to reveal in simplified terms the 2 greatest threats to the markets and our global financial stability. We are going to cut through the FUD and gossip and only discuss the truth for what it is. It does not mean it's going to happen, but it is most assuredly something that you, the investor, need to know, because it has the potential to completely disrupt more than just the crypto markets. We hear about Evergrande, but Evergrande is but an example, an indicator of a much larger economic problem brewing under all of the political chatter and social media noise. In order to truly understand the nature of this complex economic problem, we must begin in China. The first question we will aim to answer is, how can an economic crisis so far away in China impact Western markets and Western economy? China has become a peer competitor to the United States and other developed countries in terms of economic and political power. It is deploying this power in multiple ways that explicitly challenge U.S. leadership in both the economic and global political spheres. If China manages to maintain recent growth rates of around 6% a year, it will soon overtake the United States as the world's largest economy and enhance its ability to challenge global U.S. leadership position, which has been a pillar of stability since World War II. The U.S. and its allies had hoped that China would become a responsible stakeholder in a liberal international order, but these hopes have been undermined in recent years by China's increasingly apparent mercantilist economic policies, its aggressive expansion of political power, the resurgence of dominance of state-owned enterprises, and the ever more evident suppression of political liberties and traditional cultures in its sphere of influence. Mercantilism is an economic practice by which governments use their economies to augment state power at the expense of other countries. In mercantilism, wealth is viewed as finite and trade as a zero-sum game. Mercantilism was the prevalent economic system in the Western world from the 16th to the 18th century and asserts that the wealth of a nation depends on its possession of precious metals, and therefore that the government of a nation must maximize the foreign trade surplus and foster national commercial interests, such as developing a merchant marine, the establishment of colonies, and expansion of economic influence globally. More recently, economic data shows that bankruptcies are growing, returns on investment are shrinking, and capital controls are contributing to unrealistic valuations of internal capital stock and housing stock. Additionally, regulations are stifling innovative sectors of the economy, and opaque and unregulated consumer financing products are undermining central bank monetary policy and contributing to over-leveraged balance sheets among consumers and small businesses. Chinese consumer purchasing power is consistently too weak to absorb domestic production, along with incentives to increase that production, has resulted in sustained trade surpluses that create a closed loop of increased investment in manufacturing and the need for growing markets. More recently, U.S.-led efforts to deny China access to certain high-technology products and materials have underscored Chinese vulnerabilities in key sectors like telecommunications and semiconductors. Well, so what does this mean for the global economy? What does this mean for you, the crypto investor? This global dynamic results in trade tensions between developing countries and an economically questionable investment in the developing world. These tensions, along with the undermining of developing world markets through subsidized Chinese production, are increasingly causing costly disruptions in trade flows and placing pressure on the state banking system, which is the source of most external financing. If the mounting problems with the current Chinese economic model result in material slowing of growth or even sustained recession in the country of China, this would have a substantial impact on the Chinese country and the United States and its allies in two important ways. First, given that China is the second largest, or in some measures the largest, economy in the world and has been an engine of growth for economies in Europe and in the rest of Asia, a slower growth or recession in China would likely lead to a global slowdown or recession. Second, because growth has immense political salience in China, it justifies the authoritarian system of governance. A significant slowdown or recession could lead to political instability. Given Chinese nationalistic rhetoric and revanchist ambitions towards Taiwan, political instability could in turn motivate risky military activity that escalates into confrontations with democratic, market-oriented countries. From the perspective of the United States, a slowdown could exacerbate the already serious trade and economic tensions, especially if nationalist forces in China sought to cast U.S. as the scapegoat for its internal problems. In sum, a better understanding of the weaknesses within the Chinese growth model and its potential frailties would allow policymakers to craft targeted tools when needed to support U.S. policy objectives, either economic or political, and to deter Chinese aggression or the undermining of U.S. economic interests. Policy tools such as trade tariffs, export controls, and limitations on direct investments, and access to U.S. financial markets could have a significant material impact on Chinese economic performance. Even while operating in a time frame longer than 12 months, many financial analysts have begun to describe the unfolding economic challenges in the Republic of China. The general public, including political opinion leaders and government analysts, have not generally understood the extent of the danger of economic crisis in China. Instead, the common assumption is that growth in the Republic of China, albeit a continuing economic threat to the U.S. economy, is not in danger of faltering. At a minimum, various factors will slow growth to levels more characteristic of modern developed economies, and at the same extreme, these factors may possibly lead to negative growth and weakening of the political strength that underpins the dictatorship of the Chinese Communist Party. The second global indicator for economic instability would be the Omicron variant of COVID-19, which would slow global economic growth by exacerbating supply chain problems and depressing demand. U.S. Treasury Secretary Janet Yellen cited a great deal of uncertainty about the impact of the highly contagious variant first detected in South Africa. Given the severe U.S. economic slowdown caused by the emergence of the Delta variant of COVID-19 earlier this year, Yellen said that the new strain of the coronavirus could exacerbate supply chain problems and boost inflation, but it could also depress demand and cause slower growth, which would ease some of the inflationary pressures, obviously. Fed Governor Lael Brainerd, who is President Joe Biden's nominee for the U.S. Central Bank's vice chair position, has called for urgency in developing a digital dollar, saying in July that she can't wrap her head around not having one when China and other countries are developing their own central bank digital currency. Yellen responded by saying that this is a decision that's important and needs to command consensus. She admitted that there are benefits to a digital dollar, but there are also meaningful costs. She said it can work to disintermediate the U.S. banking system, and that she has not taken a position yet on the issue of a U.S. digital currency. While much of the FUD that has been spreading from opponents to the globalized integration of blockchain technology is tied to what's taking place outside of the regulatory space, one conversation that's getting lost is about the power that blockchain technology could play in the regulated financial industry, specifically in banking. Smaller commercial banks are exploring the various ways that blockchain can be brought into the fold of the central banking system. Some of the ways that blockchain technology will evolve and spread into the centralized banking system in the future, in the very near future, are payments. Using blockchain for payments and transactions is probably the most obvious ways for banks to adopt the technology. Utilizing a stablecoin, banks will not only speed up transactions and lower the cost to send them, but open up the ability to send and receive payments outside of the Federal Reserve's banking hours. Number two, added security. The ability to couple payments with smart contracts allows banks to connect multiple data points, follow preset conditions, or utilize data to navigate transactions that require interdependencies. This will allow banks to manage complex transactions in a much more streamlined and secure way. 3. Infrastructure. Beyond payments, blockchain provides banks the opportunity to streamline complex workflows and optimize internal processes. Much of the inner workings of banks are still built on siloed systems, often resulting in manual processes. Blockchain technology can enhance the connection between different critical infrastructures and limit the manual process in which large amounts of data are exchanged. While the rhetoric of many of the cryptocurrency space challenges the power of a central banking system, it's important to remember that the regulations that commercial banks follow are in place to protect consumers and maintain the strength of the American economy. A recent report on stablecoins from the three main regulatory bodies, that would be the President's Working Group on Financial Markets, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of Currency, is the first form of guidance banks have seen and a glimpse of how they will be able to utilize the blockchain technology. The report has provided a legitimate glimpse into what the future holds for blockchain technology over the next 10 years and clearly states that stablecoins, if well designed and appropriately regulated, could support faster, more efficient, and more inclusive payment options. Of course, it also touches on the potential risks, providing banks with a deeper understanding of what they need to prepare for in defense of this looming threat to their overt and historical control over the masses. But the attractiveness of banks having the ability to mint their own coins is paving the way for a new wave of cryptocurrency in the very near future. As momentum continues to increase, banks are building use cases and exploring ways their operations can be streamlined through the use of blockchain. So while the world faces significant and imminent threats to its economic stability, the blockchain industry is no doubt also on very shaky ground. But just as we have seen in other global financial disasters, we will overcome. And once the dust settles, what will be left there standing in the gleaming light breaking through the dark cloudy skies will be the unchanging golden shimmer of cryptocurrencies, finally revealed as the savior many YouTube prophets had so selflessly proclaimed. Finally accepted for all those who believe, to solve all of our woes, the many centuries of financial oppression and centralized abuse of wealth and power.